Okay, we are recording. Hi there, everybody. So I'm doing this recorded lecture today for chapter 5, and that is the next chapter that we'll cover together in our textbook. And basically, chapter 5 finishes out the accounting cycle. And so in chapter 5, we're talking about step 8 and step 9 of the accounting cycle. And as we'll see in the PowerPoint, step 8 is the closing entries. So at the end of the year, we do our closing entries and then the post-closing trial balance. So the trial balance that's prepared after the closing entries are recorded. So I'm going to share my screen with you and get the PowerPoint pulled up, and then we will look at this together. Let's see here, share screen. Okay, so chapter 5, again, we are going over the PowerPoints in this recorded lecture, and we are covering the last couple steps of the accounting cycle, which are the closing entries and the post-closing trial balance. So some of the things that we'll be looking at in this chapter, again, we'll look at the accounting cycle overall. We've talked about the accounting cycle several times in class together, but we'll kind of look at all of the steps together. Journalize and post the closing entries, prepare the post-closing trial balance, look at the differences between the cash basis and the accrual basis of accounting, and then look at preparing our financial statements. Okay, so here is the accounting cycle. Again, we have been talking about this accounting cycle continually over the past couple months of the semester. And so step 1, we said analyze transactions. Step 2, journalize transactions. Step 3, post the transactions to the T accounts, AKA the ledger accounts. Step 4, prepare the unadjusted trial balance. Step 5, we do our adjusting entries, which we talked about in chapter 4. Step 6, we prepare that adjusted trial balance with all of our adjusting entries that we, once we do our adjusting entries, we update the balances in the account, then we prepare the adjusted trial balance. After we prepare that adjusted trial balance, we can prepare the financial statements. And again, and I mentioned this in class together, if we are a company that closes our books every month we would get to step 7, right? Every month we would get to step 7. Every month we would prepare the financial statements. Step 8 and step 9 are reserved for the end of the year. So at the end of the year, if we're on a calendar year, at the end of December, then we would do our closing entries, and then we'd prepare this post-closing trial balance. So technically, there are 9 steps of the accounting cycle. In this graphic or this illustration, it's showing you a step 10. But as you can see, step 10 is optional. Step 10 is for reversing entries or correcting entries if necessary. So, after we prepare the post-closing trial balance, if we realize, maybe something was not recorded that should have been, or something was recorded in error or something, we can go back and do reversing entries or correcting entries. But really 9 steps of the accounting cycle. And so again, in chapter 5 now, we're focusing on hot dog. In chapter 5, we're focusing on the closing entry, step 8, and then preparing the post-closing trial balance, step 9. Okay, so this is another way that your book shows you the accounting cycle. Basically, we start with source documents. These are things like checks, invoices, receipts, cash register tapes, labor time tickets, or could also be, bank statements, things like that, right? So from the source documents, we analyze and journalize the transactions. We post those transactions to the ledger accounts, AKA T accounts, right? And then from those T accounts, we can prepare our first trial balance, the unadjusted trial balance. Then we do our adjusting entries. We prepare the adjusted trial balance. And then from that adjusted trial balance, we prepare our financial statements. So income statement, statement of owner's equity, balance sheet, right? And then we do, and that's step 7, the financial statement, step 7 of the accounting cycle. Again, we get to step 7. If we are a company that closes our books every month, we get to step 7 of the accounting cycle every month. And then step 8, journalize the closing entries. And then we want to post those closing entries to the ledger account and then prepare the post-closing trial balance, right? And that ends the accounting cycle. Here are the normal closing entries. There are 4 closing entries that we'll get practice with. Well, we'll see examples, of course, in the PowerPoints, but then we'll get practice with them together in class. All right, so the purpose of the closing entries is to close out or zero out the temporary accounts, right? The temporary accounts are the red accounts, right? That's the acronym that I like to use for it, the red accounts, the revenue accounts, the expense accounts, and then the drawing accounts, right? So we do our closing entries to close out those temporary accounts and prepare for the upcoming new year, basically. And so once we close out the revenue, expense, and drawing accounts, we update the owner's capital account with any income that was earned or loss that was incurred. So just like it shows here, the closing entries are made after the last adjusting entry and after the financial statements have been prepared. So, you know, again, I know I've said it a couple times already, but if we're a company that closes our books every month we get to step 7. Every month we prepare the financial statements. Step 8 and 9, the closing entries, the post-closing trial balance are reserved for the end of the year. If we are a company that closes our books quarterly, so we close our books, you know, every 3 months, then we would get to step 7 every 3 months. And then again, step 8 and step 9 would be reserved for the end of the year, right? So once we do our closing entries, then these temporary accounts, again, the red accounts is the acronym that I like to use. The revenue accounts, the expense accounts, the drawing accounts will be closed. There'll be zero balances zeroed out to prepare for the upcoming new year, the upcoming accounting year. All right, so again, as we mentioned, revenues, expenses, drawings, or owner withdrawals are temporary accounts. So we have to zero out these balances to prepare for the upcoming new year. And once we do the closing entries and we go through the closing process, all that will be left are these permanent accounts. And you'll notice these permanent accounts are the balance sheet accounts, right? So all that'll be left are the assets, liabilities, and owner's capital account. Sorry, I thought I put my phone on. Thought I put my phone on silent. Okay. So once we do our closing entries, again, all that'll be left are these permanent accounts, assets, liabilities, and then the equity, you know, or owner's capital accounts, which is, of course, what makes up our equity. And so the closing process, you know, again, we identify which accounts need to be closed. We record and post the closing entries, and then we prepare the post-closing trial balance. The closing process is to zero out or reset the revenue, expense, and withdraw accounts to zero balances at the end of the period. And then we also will use this income summary account to transfer over any income earned to the owner's capital account. And so again, we're going to see examples of these. We're going to get practice, of course, with this in class together. So recording our closing entries, there are 4 closing entries that we'll do together. And so the first one that we do is to close out the revenue accounts, right? Revenue has a normal credit balance. So as we'll see, to close out our revenue accounts, we're going to debit the revenue. Step 2, close out the expense accounts. So again, expenses have a normal debit balance. So to close them out or to zero them out, we're going to credit the expenses. We do the opposite, right? Step 3 is to transfer any income to owner's capital. And then finally, step 4 is to close withdrawals to owner's capital. So remember step 3, owner's capital increases with a credit, right? Owner's capital has a normal credit balance. So when we're transferring income to the owner's capital account, we're going to be crediting owner's capital. And then when we have to close out withdrawals here in step 4, when we close withdrawals to owner's capital, we'll be debiting owner's capital. So here's an example of what that looks like in the T accounts, or what those look like in the T accounts. So again, step 1 is to close out our revenue account. And so we see here that revenue has a balance of 78, or consulting revenue has a balance of 78.50. So to close that out, we're going to debit it for 78.50. When debits equal credits, it's a zero balance, right? Rental revenue has a credit balance of 300. So again, to close that out or zero that out, we are going to debit that account for 300. When debits equal credits, that's a zero balance. And that entire amount gets, so we're debiting the revenue, crediting income summary. And so we see that credit there to income summary, 81.50. And then the expense accounts, again, expenses have a normal debit balance as we see here. So to close them out or to zero them out, we have to credit them. And so we're crediting each of our expense accounts. Once debits equal credits, that's a zero balance. And the total amount of our expense accounts, because we're crediting all these expense accounts, we debit income summary for that amount. The difference is, again, 81.50 represents our revenues, 43.65 represents our expenses. So the difference between these two numbers is our net income, 37.85. And so 37.85 is what we are going to transfer to the owner's capital account. And so we do that here on our third entry. We transfer that 37.85 to the owner's capital account. And then finally, the fourth entry is to close owner withdrawals or owner drawings. Oh, hot dog. Owner drawings. So owner drawings have a normal debit balance. So again, to close that out or to zero that out, we're going to credit it. And of course, when the owner withdraws money, that reduces capital, as we have seen on our statement of owner's equity. So then we're debiting capital, which reduces that owner capital balance. All right, so here's an example of closing the revenue account. You know, again, we want to use this income summary account. Income summary is just a temporary account that we use to transfer income to owner's capital. So if we have income from tours or revenue of $23,320 that has a credit balance, we're going to debit the revenue account, credit income summary is what that one would look like, right? So we're debiting revenue, crediting income summary. And so just like we see here, when debits equal credits, that means it's zeroed out. It's a zero balance. All right, this one, and I know here I'm going to try to blow this up a little bit because it's a little bit hard to see. But with our expenses, again, expenses have a normal debit balance. So to close them out or to zero them out, we're going to credit all these expenses. Once we credit the expenses, then it's a zero balance, and we're debiting income summary for the total amount. All right, again, when we think about this income summary account, it's a temporary account that we use to transfer net income. So once we transfer net income, income summary will also be a zero balance, right? But right here, what we're seeing is that in our income summary account, we have revenue of 23,320. We have expenses of 6,524. The difference between those two, revenue minus expenses, equals net income, right? And so that's what we're going to transfer to the owner's capital account. All right, and we see that here. So again, in our income summary account, we see revenue 23,320, and then expenses 6,524. So that means we had a net income of 16,796. And again, we debit income summary, credit owner's capital. That increases owner's capital, right? And then same thing, if we have, and so this first example up here shows us, you know, when we have a net income, when we earn a net income, then we're going to debit income summary, credit owner capital. But the second example down here is showing us when we have a net loss. So if revenue was 2,400 and expenses were 3,000, that means we had a net loss of 600. So then to close out this account, we would debit owner capital, which decreases owner capital, credit income summary. All right. And then finally, we have to close out the owner drawing account. You know, again, owner withdraws or owner drawings have a normal debit balance. So to close it out, we've got to credit it. And owner drawings reduce owner capital. So we're debiting owner capital, which reduces owner capital, crediting owner withdrawals or crediting owner drawings. So here's an example of what those journal entries would look like. This first one, again, is to close out our revenue account. So we see a debit to revenue, a credit to income summary. The second one is to close out all of our expense accounts. So again, we're crediting our expense accounts. The debit is to income summary. And then whatever the difference is between revenue and expenses, of course, that's our net income. And that's what we're transferring to owner capital. And so we do that by debiting income summary, crediting owner capital. And then lastly, we see step 4, we're closing the owner withdrawal accounts. Owner withdrawals reduce owner capital. So we're debiting owner capital, crediting owner drawing or owner withdrawals. Okay, once we do our 4 closing entries, we post the closing entries to the T accounts. Then we prepare the post-closing trial balance. Again, this post-closing trial balance, step 9 of the accounting cycle, right? So just like it shows here, post-closing trial balance is prepared using the final balance figures from the ledger accounts. The accounts that remain on the post-closing trial balance are the permanent accounts, and these are the balance sheet accounts, so assets, liabilities, and equity. The permanent accounts carry forward to the next year. So, you know, again, if we think about, you know, we do our closing entries at the end of December, and all those accounts that we close, revenues, expenses, and drawings, they're at a zero balance then when we start our new year in January. Whereas the permanent accounts, the assets, the liabilities, the equity, they carry forward to January, right? So whatever the balances are in assets, liabilities, and equity, those balances carry forward to the new year, right? And just like with our other trial balances, right? Because remember, we prepare the unadjusted trial balance step 4. We prepare the adjusted trial balance step 6. And now this is step 9, the post-closing trial balance. So with all the trial balances, the purpose is to make sure that the debits equal the credits, right? So we see an example of this post-closing trial balance here. Again, looking at this trial balance, you see asset accounts, you see liability accounts, you see the owner capital account, the equity account. These are our balance sheet accounts, right? You do not see revenues and expenses or drawings, right? Because we closed out those temporary accounts. So all that's left, again, are these permanent accounts, namely assets, liabilities, equity. All right, so then cash basis versus the accrual basis of accounting. So for us, we have already been practicing the accrual basis of accounting, and we will continue to practice the accrual basis of accounting. And the reason is that the accrual basis is the generally accepted accounting principles, right? So when we think about the cash basis versus the accrual basis, if we were practicing the cash basis of accounting, there would be no need for accounts receivable or accounts payable, because with the cash basis, revenue is recorded when it's actually received in cash. So, again, we've been using the accounts receivable account, but with the cash basis, revenue is not recorded until we actually receive the cash. So there would be no need for that accounts receivable account. And then likewise, with the cash basis of accounting, we would not need the accounts payable account, because with the cash basis, just like it shows here, expenses are recorded when they are paid in cash. So we wouldn't record the expenses until we actually paid in cash. So there'd be no need for that accounts payable account. Again, the cash basis is not GAAP. The cash basis is not the generally accepted accounting principle. So we will continue to practice the accrual basis of accounting. The accrual basis of accounting is the generally accepted accounting principles. And so basically, under the accrual basis of accounting, we have the expense recognition principle, or the matching principle that we talked about in chapter 4. And then we have the revenue recognition principle, which says that revenue is recorded when it's earned rather than when we receive the cash. This is why we have that accounts receivable account. And expenses are recorded when they're incurred rather than when we pay the cash. That's why we have that accounts payable account. So again, we have already been practicing the accrual basis of accounting, and that's what we'll continue to practice. That is the generally accepted accounting principle. All right, so this example is just showing you a difference of the cash basis versus the accrual basis. So it says, Roby Hair Salon pays $6,000 cash in July for the current month, July, and the following 5 months of rent, August through December. So we pay $6,000 cash in July, and that's for our rent for the next 6 months, right? Our rent is $1,000 a month. And so it's just showing us here how we would record that expense, right? So if we were using the cash basis, we would record that entire expense in July. Whereas the accrual basis, we would record $1,000 rent expense each month. And in fact, what we would do is when we paid this $6,000, it would be, debit to prepaid rent, a credit to cash. And then every month, as we did our adjusting entries, every month, a little bit of this becomes rent expense, right? So in July, for example, we debit rent expense, credit prepaid rent. And then in August, we debit rent expense for $1,000, credit prepaid rent. And then in September, we debit rent expense for $1,000, credit prepaid rent, right? So with the accrual basis, we divide that expense up, we divide that expense over the time period that it covers. Same thing that we do like with prepaid insurance, for example. All right, so this practice exercise, we'll just talk about this a little bit together. So it says, Considering the following events, determine which month the revenue or expenses would be recorded using the accounting method specified. So letter A, Crane Company uses the accrual basis of accounting. Crane prepays cash in June for insurance that covers the following month, July only. Okay, so we paid for this insurance in June, but it actually covers us for the month of July. So when we record this, what we would do in June is we would debit prepaid insurance, credit cash, right? That's how we'd record it in June. And then come July, once we are covered by that insurance, the month of July, we would debit the insurance expense, credit prepaid insurance. Okay, letter B, Loggins and Rogers Tax Services uses the cash basis of accounting. Loggins and Rogers receives cash from customers in January for services to be performed in March. So since this is the cash basis of accounting, when we receive this cash, we would record the revenue. So we would debit cash, credit revenue. If we were using the accrual basis here for letter B, then we would debit cash, credit unearned revenue. And then that unearned revenue adjusting entry would be done in March. So, okay, letter C, Red Tractor Supplies Company uses the accrual basis of accounting. Red Tractor Supplies makes a sale to a customer in September, but does not expect payment until November. So again, under the accrual basis, like we have been doing, we would debit accounts receivable, credit revenue, right? And then when they paid us in November, we would debit cash, credit accounts receivable. So that, again, that's what we have been doing, right? If for letter C, if we were using the cash basis, we would not record the revenue until November when the customer actually paid us, actually paid the cash. Okay, letter D, Norton Company uses the cash basis of accounting. Norton prepays cash in February for insurance that covers the following month, March only. So again, even though the insurance covers us for March, we paid the cash in February. So under the cash basis of accounting, we would recognize that expense in February. So in February, we would debit insurance expense, credit cash. Okay. Again, once and we've talked about interim financial statements a little bit already. Remember, interim just meaning like in the middle of the year. So interim financial statements are financial statements prepared during the fiscal year for periods of less than 12 months. So again, every month or every quarter or every 6 months, right? Those are interim financial statements. And just like it shows here, businesses prepare interim financial statements monthly to provide up-to-date information about the results of operations. So again, every month, generally speaking, any company of significant size is going to want to know every month how much revenue came in that month versus how much in expenses went out, right? But remember, those interim financial statements combine together to make our annual statements at the end of the year. So if we prepare interim financial statements every month, the 12 months through the year are then going to combine together to make our annual financial statements at the end of the accounting year. All right, so this illustration or kind of little bit of a flow chart, I guess maybe you could say, out of your book, shows this a little bit. We might prepare, our income statement for the end of January, for the end of February, for the end of March, for the end of April. And we prepare our balance sheet as well, each of the, end of those months. But again, those financial statements then are what contribute to our annual totals, or what become, when we add all those together, our annual total. So, again, if we take, income from January, income from February, income from March, income from April, income from May, income from June, July, August, September, October, November, December, all, the income from those 12 months is then what adds together to become our total income on the annual financial statements. All right, I'm not sure that we'll get to all these exercises and problems together in class, but these are some of the exercises and problems that'll help you get practice with these. And then, of course, when we meet together, we'll be practicing some of these in class together. As always, once you have a chance to view this recorded lecture, please let me know if you have any questions. Hi, guys. Okay, so yeah, I know that this week we're finishing up chapter 4, or actually we finished up chapter 4 last week. You guys are taking an exam this week, and then again next week we start chapter 5. So I look forward to seeing you guys in class. Bye-bye.